morning, everybody, and welcome to the technical market call for the Fed report for June 23rd, 2011. Guys, this is going to, we'll get right into it, by the way. I always say we'll get right into it, so I'll say it here. This is going to be a very frustrating 2 weeks, especially for stock traders, if I'm going to be right on this thing. And the reason I say that is, if I am correct, we have embarked on a period of violent up and down movements where we are basically going to end up at the end of a couple of weeks slightly down from where we were a couple of days ago. But it's not going to be a big down playable move. It's going to be up and down and up and down, and probably closing out at the end of June around 125 to 126 on the spider. In other words, right around here. But we should be all over the place between that. Note, by the way, when you look at the S&P today and the spider, and you realize that we are right down again at the lows here on the spider, and then go look at the transports, which are way above their lows. The low on the transports when the spider was down here before on the IYT was 91.70. We're at 96.10 and almost positive now. If you look at the IWM, the Russell 2000, the low where we were a few days ago was 77.40, and we're nicely above that now. So what I think we're seeing here is what happens often when the market gets a little bit oversold, which is a period of testing and stuff. What this will do in terms of the technical indicators is create a bunch of divergences and stuff, and more importantly, you can even see this already on the IWM, where the 5-day moving average actually starts to go up but has not crossed. The 20-day moving average flattens out, and basically the net result is you are in a position where we can ultimately get a really good buy signal in a week or two. So what I would be doing here is very slowly and gently adding some more money in to stocks in strong sectors, with the idea being that we're going to want to have positions, be as fully invested as we get by, say, the second week in July. And obviously, we're trying to look out about 4 weeks here, and that can be hard. It may be sooner, it may be later, but this action is not bad. Another really good thing that has happened for us is percent bears on Investors Intelligence last week was 28%, which is getting remarkably close to 30% and is considerably better than the 19% of a few weeks ago. Now, what's happening is my model is basically a moving average model. So the numbers that are falling off are in the 19s and 20s. The numbers that are adding in are the 26 and 28s. And if we can keep sort of fluctuating around with sort of bad news and such, what's going to happen is that sentiment model is going to come up into the mid-20s, and we'll be in position to generate a buy signal on that model as well. So, guys that are really bearish here, I'd be a little bit careful, with the idea being that you're going to be wanting to be positioned in stocks for a rally the latter part of the summer, and you want to start doing it now while we're down. And in strong sectors. I think oil is a strong sector. I think consumer discretionary isn't as strong as consumer staples, but discretionary. But, basically look at our overweights, look at our underweights. The other thing I would do, especially for Merrill Lynch brokers on the call, have a look at some of the banks, including adding Bank of America in here. When we started talking about that in early June, the stock was around 11.10 to 11.20. It's not even down 10% from there, with the market all over the place. If this stock starts making it through 11.10, we could see 13 by the end of the year. This is not a trade, by the way, guys. This is a 6-month outlook sort of thing, and I would really look very hard at that. The 5-day moving average is flattened out. The 30 is starting to flatten out. The stochastic is diverged and is positive. All sorts of things are suggesting that when the moving averages do go positive on this, and they have been negative since March, this could have a nice little run. So guys, watch the financials, which nobody likes here. Watch some of the big cap, consumer-oriented stocks. We'll talk about some of those in the rest of the call, and realize that this is going to be, especially if you're trying to trade this thing, where you're bullish one day and bearish the next and buying, trying to trade, this is going to be among the most frustrating periods that everyone is going to remember ever, as we go straight up and down between 126 and 129 on the spiders, probably 5 to 7 times between now and mid-July, if I'm right, with no net progress. And then what that serves to do is when you finally really start to go, no one will buy it. Let's talk about bonds for a minute. I'm seeing all sorts of signs on the TLT that bonds are actually in a selling position. I would be starting to liquidate my trading positions in bonds while they're up here. If you take a look very carefully at the TLT chart, you will note that bonds have not made a new high since the 6th of June. They're trading like they want to go lower, but it's going to take some time. It's sort of like, anytime you change one of these trends that's been in effect for a while. I would be transferring clients into high-grade corporate. The LQD looks much better, although it hasn't made a new high either. The other real sleeper bond trade for people that are looking for yield, and this is probably going to really bear fruit when the stock market starts to go, but take a look at the HYG and high-yield bonds. Those are actually trading like they could work their way a little bit higher. Again, this is not one of those things where you leap in today. It's where you start to add very slowly to the HYG and maybe start to very slowly sell the TLT, get yourselves down to underweight on bonds for the second part of the year. Looking at the commodity markets, gold looks much better than silver. The accumulation model on gold, by the way, looks really, really good. That's suggesting new highs in gold in the next few months. So I would be certainly looking at gold in here with an idea towards adding it. And again, guys, we follow the GLD. If you take a look at the IAU, it has the virtue of being cheap. It is trading only in the $14.84 range. So if you want to play something that's not $140, play the IAU. The chart pattern is the same. The one thing I still would avoid, silver still doesn't look particularly attractive to me. It looks much worse than gold. That is, however, as we have mentioned, as it should be. So I would say to myself, I would be taking my silver money off the table. I'd be putting into IAU. One way to do this might be to take your silver, which is trading in the $30 range. If you've got 1,000 SLV, sell that and buy 1,000 IAU. Keep the money so that when gold starts to go, you can actually add to it higher if you want to be a little more prudent. Oil has filled its gap. It is sort of bouncing around, but I think it is going to be higher at the end of the summer than it is now. The one bugaboo with oil may be the dollar. I think the FXE does look like it's going to crack through 140. I do think this Greek thing is a real problem still, and my favorite speculative trade remains the dollar. And I would be looking to buy the dollar index or the UUP. Note, by the way, there are tremendous divergences between the performance of the UUP and the DXY. We've published that chart. But note that the UUP is consistently lagging the dollar index, and then the question you got to ask is which is the dog and which is the tail. I think in this case, the dog is definitely the dollar index, the tail is the UUP, and the dog is going to wag the tail. In other words, if the dollar index really starts to go, the UUP is going to have to catch up to it. So I would be definitely looking at that UUP with the idea being, and again, on dips, I don't think this is an emergency quick situation, but you want to be in there for a move up into the 23-24 area ultimately. We're going to take a look at some stocks. We got an email with a bunch of them just before our main stocks came in. So